Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Well, g'day everyone, it's Liam Garman here, editor of Smart Property Investment, back today with another episode of the Smart Property Investment Show, and I'm joined by an amazing guest, Dawn Fouhy, co-founder of Future Proof Property Advisory. Dawn, welcome to the podcast.
Thanks, Liam. Nice to meet you.
Nice to meet you too. Flew up this morning from Melbourne.
Yes, from sunny, balmy Melbourne.
Sunny, balmy Melbourne. Oh, what's the temperature like at the moment? 20 degrees as we move into spring.
Well, it's about 18 degrees.
But today we have an amazing podcast today talking about your investor journey and how you came to found Future Proof Property Advisory and some of the cool stuff that you're doing at the moment, some of your insights into the market and some advice that you can give new investors. That's going to be the name of the game today. But Dawn, to kick us off, you have a pretty cool history in the world of property investing. You started investing in property at 28. You had quite a meteoric rise. Before that, you were working as a nurse as well. Give us a little bit of insight into how you started your property investing journey.
So I came from Ireland. Shocker. So
I should have started off with that, actually.
middle of nowhere. So eldest of 4 kids. And just grew up in rural Ireland and came to Australia. Was working as a nurse and met my partner Melissa here. And we bought our first property at 28. And it was a unit in a nice suburb of Melbourne. It was only 80 square meters. And it's really interesting when I reflect back on that time. Okay. So the unit at that time was affordable for us. All right. So I want people to start thinking and relating that to the cycle today. It was affordable for us as first home buyers at the time. When we were bidding for the property, it was only us and it was an investor. And the investor had a little notepad out, like a reporter's notepad, and he was capped out at 480. We bought it for 481. Didn't realize we timed the market perfectly for that unit. Fast forward 3 years later, we sold that property for $200,000 more, an 80 square meter unit. Why? First home buyers from the neighbouring suburbs that were more expensive were priced out. The ripple effect, we had 30 people at the auction, multiple bidders, and sold on the day to another first home buyer. That unit, after 11 years, is now worth $850. So it doubled. It's 80 square metres, one of 12 units, a villa unit. Nothing special, but affordability, scarcity, it did the trick.
You didn't realise that you timed the market is it's quite an interesting insight. What would you say to people that they get emotional when they're investing and they might have timed the market wrong and they're looking at their PPOR and they're like, well, I don't necessarily want to part with it because it hasn't gone up that much. What would you say to them?
I always say this because a lot of people, when they upgrade their PPOR, they keep their first PPOR as a investment. I always say to them, if you were buying an investment today, would you buy that? And they always say no. And I said, well, then it's not an investment. You are emotionally tied to the fact of having multiple properties. So unless it's growing, why are you holding it? You should be selling it, taking advantage of paying no capital gains tax on it, moving that money into your next upgraded PPOR, or going down the path of rent vesting. If you, as you said, made a mistake, you might have bought at the top of the market, you might have overpaid at the top of the market, which often happens to first home buyers. It's very common.
Now, let's talk about your time as a nurse with your partner, Melissa. And I know just before the podcast, you and I were discussing, you two were unpacking paths to success and paths to wealth. And you, is Melissa a nurse as well?
No, so she actually worked for Victoria Police as a project manager. So she's really the brains of the operation. Yep. She's very methodical, the smartest person I know ever. She's so intelligent in every aspect. And we basically came from, nothing really. So our parents always worked really, really hard, blue collar jobs. And so for us, we were always like, how do people afford to go on multiple holidays? Or how do people afford to send their kids to private school. And I know that sounds a bit contrived, but we always had that wanting to figure out, well, how does this happen? So common denominator we found was that people had investment properties. So we really then self-educated. So consumed, of course, standard Rich Dad, Poor Dad, every book you can think of, Steve McKnight. Instead of watching TV shows at nighttime, we would watch YouTube for hours.
Really?
Yeah, we
So
were like
you
the
were
biggest
on this journey
nerds
together. Like
we were both like so into it, so
Yeah.
hyper focused on it, writing down notes, taking different people's opinions, and then trying to align a strategy that suited us. Looking back now, we probably outgrew our mortgage broker quicker than we thought, and this is something I would say to other people out there. Get advice from lots of different brokers, because your broker might be carrying their own bias as well, and they might not want you to keep investing. Because we actually bought 4 properties in 1 year in 2022. We had savings, we had equity, because we'd bought another townhouse in Melbourne at that time, because that's the natural progression of a first home buyer, right? Unit to townhouse. So what we did then was we had savings, we unlocked the equity, and we went and bought 4 properties. Our broker was like, are you sure? Like this lender is like with, Pepper, it was like 8%. And we were like, yeah, no, go for it. So I still remember the first investment property we bought interstate. I was on night shift, and I remember it was in Perth. And I remember closing the deal at like 10 p.m. on a Friday night on night shift in like a storage cupboard. Talking to the agent, I was the only bidder on this property in Perth at the time.
Yeah.
And it was a property in Port Kennedy, low 400s, 700 square meters. Standard. Has done really well. Has doubled in the last 3 years. And the rents have gone up as well. So if you're new to investing out there as well, really focus on the fact that your yield today won't be the yield tomorrow. Focus on areas that have the propensity to grow in yield as well as capital growth. And don't let a lower yield on purchase price put you off. Focus on capital growth.
And that's something that you're seeing with a lot of new investors that you're meeting, that are approaching you, is that they are very yield focused. And I know one of your core philosophies is yield's good, but to balance it out with that capital growth aspect. Am I getting that kind of philosophy correct?
You are spot on. So there's no point in, buying a property in Emerald, Queensland and being $300 positive a year. That's not going to give you generational wealth. And
$300 positive a year.
Yeah. It's not going to create a lifestyle of freedom, right?
At that point, just get an extra shift at Macca's a week if you have to.
100%. I always say to people, focus on your careers, focus on your business to grow your cash flow, and just hone in on capital growth properties.
So is that, there seems to be a bit of a changing tide with this. So with that example, a lot of new people coming into the market, a lot of investors coming into the market are chasing that yield. What do you think the reasoning is for that?
I think the real impetus behind it is people are being sold a silver bullet that they can grow 10 property, $10 million portfolio on an average income. That's not true. And so, maybe they're being marketed to that you need yield to keep growing your portfolio, and you can keep buying in trusts, and we can get you 10, 20 properties. So sure, your first property in a trust, great. You may have a chance of it being positively geared in a few years, or if you offset it. But after that, you're borrowing 105%. So, riddle me this. How is that going to work out? Servicing is going to be an issue. It doesn't matter what your yield is. It doesn't matter where you buy. You're going to come up against a servicing issue based on how much you earn. What I would say to people is, instead of trying to trade properties and sell properties every 3 years, you could get your timing very wrong. I would just focus on assets that are going to give you equity in the short term, but have long-term fundamentals. Just live an easy life. Investing takes time, okay? So we've realized that over the last few years, our best performing properties are the ones we've held the longest. So because they have all the fundamentals. So owner occupiers want to live there. That's a future-proof property to us. Whenever I'm buying a property, I'm always looking at it through the lens of who is my future buyer and why are they going to pay a top dollar for this property over another one. And I apply that ethos to every investment decision, and every property has to have a business plan. Now, for us, we don't renovate. We don't, have never considered developing. We literally time markets, 8-figure portfolio, over $10 million. And I've never picked up a paintbrush. We've never renovated. We have timed markets. And it's a 70% LVR, and we're still stripping equity out and buying.
The way that you're approaching this is quite different to a lot of even guests that we've had on this show, which is perhaps you're more level-headed in your approach to property. And I mean that in the sense that there are a lot of people, you see it on Instagram, you see it on TikTok, where it's, overnight you can become a millionaire. And there is that... and it's aspiration's good, but perhaps not necessarily well-founded goals and objectives in the long run. Perhaps people that come into property seeing it as a get-rich-quick scheme because they saw their cousin, they bought the house in the growth area, they timed the market right, like as you highlighted, and they think, hey, I'm going to get rich quick overnight as well. You mentioned something which is, hey, you're not gonna build this off an average income. I want to unpack that a little bit more. If you are on an average income, what is your advice to our listener that they can at least get on the market, that they can start navigating, that one day they can build that family wealth?
Great question, Liam. So for me, it's talking to what we've built personally. So while I was nursing, Mel and I, our joint household income was probably around 220,000, okay? Joint household income. So we were able to build a near $4 million portfolio on that income. And how we did it was we'd used equity from our PPOR that we had purchased, but we had savings. So, and I think that's what people don't talk about as well, is that we were really good savers. I worked 2 jobs. So there is an element of sacrifice. I think what people are missing out there is that, and I talk to people every day who say that I want to retire in 5 years on 200K net passive, have no maintenance, have the properties pay for themselves, but I only earn 100K. And I'm like, where did you hear that?
Yeah.
I'm like,
we're going to have to refix our expectations here. Yeah.
So the clue is in the word. So to invest means you have to put in time and effort, and maintenance costs a fortune. So even we have a property in Mackay, which paid $6,000 recently for like a roof that was leaking. A property we have in Australand in our super, a pipe burst. So like investing isn't without its risks. It will cost you money. You're dealing with bricks and mortar. You're dealing with people. My job and what I like to do, what we've done for our own portfolio, is make it as easy as possible. Buy in areas where the tenants aren't going to give you headaches. Buy in areas where owner-occupiers are always going to want to live. And that doesn't mean they're blue chip. So we're not spending like millions of dollars on property. And still to this day, we're not. Our sweet spot now has evolved to, that 700 to like 850. Higher socio affordable market that has propensity to double. If I was starting now, what would I do differently? I never would have bought a PPOR.
Yeah. So you're very firmly in that rent vesting camp.
100%. Yep. If you are in your 20s and you're living at home, and we help these people all the time. Yeah. So we have people in their 20s, their parents are guarantors, they're living at home. We're getting them great assets for, that 500K. But these are, but caveat, we don't buy in towns of 8,000 people. Yeah. We still will get them assets of 500K in major regional centres or metro locations. Why? We want to mitigate their risk. Yeah. So that's really important to me, is to look after people. Our whole business is about looking after people and not using clients as a ladder to supercars. That's not what we're about. We're not scaling our business. We are about genuinely looking after people and building portfolios.
In terms of your own journey, and I know you mentioned that yourself and Mel, you were consuming the knowledge every night. You're watching all the YouTube videos. You're reading all the books. A lot of couples actually aren't on the same page. I think, you both were quite fortunate that you saw this and you had the conversations with people. And I think it's very reasonable to say, because I've even done my own budgeting, looking into the future. And I'm like, how do I afford like a private school? And then I'm looking at it now and I'm like, oh, and maybe there's the argument that over leveraged, whatever. But now even I look at it, I'm like, whoa, it is hard. How do you afford the overseas holidays? How do you afford this? How do you afford that? So I think it's a very reasonable thing that a lot of couples would be looking for new avenues for capital growth that they can get their money to work for them. What do you say to clients that, maybe they're in a couple, maybe they're married, they've got a long-term partner, but they're not necessarily on the same page? How do you kind of coach through that?
That's a really good question. And that's very common. So we'll often encounter couples that have different risk appetites. So one partner might want to take it to the moon and the other partner isn't comfortable in carrying debt. So then we meet them in the middle and we give them options. So the biggest anchor on any household in Australia with people we talk to is their mortgage. So the average mortgage size is about 700K. We'll often work on a plan with just 2 properties to try and get them mortgage free in that kind of 8 to 10 year window by timing a market, holding those assets. That can often appeal to a partner that's less, is more risk adverse. So I think it's about you kind of taking your partner on that journey with you. If they are hesitant to investing, just find somebody that they can connect to and show them that if you were mortgage free, you might be able to go part-time or you might not have to work at all. It's going to save you 70 grand a year on a mortgage because everybody preaches this 100K net passive income. I can tell you right now, that the 100K is now 200K net.
Yeah.
So inflation. So the sole and only goal should be for you to have those frank conversations with your partner and be like, are you okay with us working till 60 and just working to pay off a mortgage and pay not only 700K for the property we own, but give 700K to the bank as well. So always try and think, how are you going to have this conversation with your partner? Even Mel and I, when we were buying our investment properties, we would butt heads because I had said our second one, it was in Perth as well, and it was in neighbouring suburbs. And Mel is like, why are we buying in the same place? Why don't we diversify? And it was like, well, this horse is running. It's doing really well. Never diversify for the sake of it. Yeah. And that's another tip I would give people.
Yeah. But, look, obviously, I don't know yourself. I don't know, Mel, I know you. I don't know Mel. I can see both your arguments. And as an outsider, I'm looking at this. I'm like, well, actually, both of your arguments in that sense are actually very legitimate. But it does show that when you're going on an investing journey with someone, that there are potentially multiple correct ways to skin a cat, right?
100%. And I think it's just about compromise. And, with your partner, it shouldn't be a hard yes or hard no to investing. It should be you both figuring out why you're scared and maybe getting some education, listening to podcasts, watching YouTube, and really helping unpack that and really deciding what kind of life you guys want together. Because that's where Mel and I are really on the same page. We always have, quarterly resets on different goals we have, yearly goals, and a lot of it is around like purpose and family. So for me, that's why I'm not into the school of if you're on an average income, don't worry about getting to 10 properties. It's like, it's going to feel like you're never going to achieve it because as the markets are rising quicker and quicker, we want you to have like a future-proof plan that you can actually achieve something that's tangible, but it takes time. So I would look at this with a time horizon of 12 to 15 years. Anyone who tells you you're retiring in 8 years, you will be on a really good income. Like I mean 400K plus. And sure, we can get you great passive income then. But for the average income earner, it can still be done. It just takes time.
Yeah. Yeah. I think that's very, very reasonable. The desperation is another element of that emotional investing, right? Where you might listen to podcasts like this and you're so desperate to get on the ladder, especially if you're a young Aussie, you're so desperate to get that passive income that's when you can also start making some real suboptimal decisions. And I've seen it 1,000 times where especially people falling for, and I think it's very reasonable to say, sales tactics for some of the off the plan stuff, and then suddenly it's just you're buying with an absolute oversupply in a specific asset class. You can look at like units in Parramatta or the inner west of Sydney is a great example where they actually haven't moved over 12 years, or some off the plan areas, an hour and a half, 2 hours outside of a capital city, which also oversupplied thousands of new homes because you were so emotional, so trying to get in. which ties back into the need for that goal setting, the need to have a common North Star for yourself, your partner, your portfolio, so you're not making those suboptimal choices. You mentioned that quarterly goal setting, and I'd love to unpack that, because there'd be a method to this, right? You guys have done an amazing job. How do you sit down with Mel and set your quarterly goals and review whether you've been hitting them?
That's a really good point, because I can say we haven't hit our personal investing goals for the last quarter, and I'll tell you why. So we're lucky enough in our business, you have great deals come across your desk every day, but they go to the clients. So our own pre-approval app actually lapsed. So because we're so busy catering for our clients, we have our son. I get being time poor and not actually executing.
Who's the BA to the BA?
Listen,
right?
well, like, I'm seeing these markets rising, and I'm like, jeepers, I'm like, Mel, we need to really get stuck in. So we're buying a lot online for ourselves, and a lot of the off markets are going to the clients,
Yep.
which is really interesting.
That is funny.
But we have and you really have to work out your personal goals and your professional goals. So passive income alone isn't going to, make you content or happy. So I see that a lot with a lot of people. It's not just all about money or the cars or the houses. It's like, what's your purpose in life? What's your relationship like with your family, your friends? How's all that working out for you? So for me, I really focus on, okay, how are those goals going? That's more important to me than any portfolio. So for us, it's like our family, the clients, and our health really should be first, but sometimes that takes a back seat, something I'm really working on this year. But I think the main success to our portfolio and why we have achieved what we've achieved is constant execution and learning. So we ask so many questions all the time from so many different people. Even when we started our self-managed super, I had to learn so much about that and realized what a game changer that is. Like, we've multiple properties in our super now, with a whole strategy around how we're going to sell them, time the markets, and really take advantage of that. So yeah, I just get really excited about investing, and the more I learn, and there's different levels to it. So the more you grow your portfolio, the more you learn.
What are some of the questions that you should be asking, putting down when you're setting these goals? Now, the good thing that I have, my favorite part of this job is I get to be in front of very smart people like you, Dawn. And I get to ask questions that I think to myself that I've not done a good job.
Go for it.
My wife and I, we sat down, and it was off of a fantastic podcast that the Kumars did, I think at the end of last year, about goal setting. And my wife and I sat down, and we missed our goals, and we're now too frightened to review because, we didn't hit any of them anyway. Like, what's the point? And then it's very confronting. You're shaking your head.
I am, because you just need to set 1% goals. They don't have to be these big, audacious goals. I think that's where people go wrong. They underestimate what they can achieve in 10 years and overestimate what they can do in a year.
Yep.
People are very hard on themselves now. I think we're in a society now where you can, you have your phone, everything is instant. You can get food delivered straight away. You can, watch streaming services, do whatever. Like, investing isn't like that. You have to be methodical. I see people selling too quick. I've seen this mass exodus of investors from Perth for no reason. Our property in Perth has actually grown more in the last 6 months than it did the 6 months before.
Yep.
Because there's, I just see people making these crazy decisions without having a long-term focus.
I'd be inclined to agree with that. And this is a bit of an offside about the goal setting, but some of the and this is just conversational. Some of the fundamentals in Perth are still really strong.
They're amazing.
In terms of the livability aspect, where you can get places that are, still pretty close to the beach, relative to a Brisbane, Sydney, Melbourne, relatively close to a CBD, you're a beachside town, for the price of a very suboptimal, I don't even think anywhere in Western Sydney you'd get, for the price of a very average unit in 30, 40 minutes away from Sydney CBD.
Correct.
And you're paying the same price. This is, the fundamentals of this are really rock solid.
And the people, it's all about the affordability metrics. So the people in Perth, aside from Darwin, they earn like a lot of money every week. There's a lot of money in Perth, and the houses are still very undervalued compared to incomes in some areas. So would I be rushing into certain areas? No. Would I be looking at perhaps areas that haven't moved as much? So, I might be having a look at, like tapping in WA, but that has an entry price point of 800. But does it have the propensity to double? Absolutely. Why? There's scarcity, people earn a lot of money, and there is demand through the roof.
Absolutely. Before, and I'm jumping around on this podcast because Dawn, you just mentioned you mentioned so many good crumbs, and as our YouTube watchers can see, I've been writing down a lot of questions, and I've gone completely off the script.
Well, we just
here,
want to help people, Liam, right?
But this is great. And you mentioned something before about regional and buying in a town of a few thousand people, which you might get that good yield, but also for me as an investor, it doesn't sit well in my heart of hearts because the lack of, say, economic industrial diversification in these towns means that in some areas, not all of them, but in some areas it can be exposed to market downturns. And obviously there's huge upside, when we're selling oodles of coal and iron ore to a neighbour up north, great. When that slows down, not so great. So it makes me wonder, and you did mention that you're not saying no to regional areas, you're not saying no to outer metro. My question is, what makes a good regional area to invest? What is what's future-proof's kind of go, no-go underlying methodology in picking these towns?
That's a really, really good question. So for us, it has to we really want to see population growth. So we want to see projections on what the population growth is going to be in an area. First of all, we want to see industry diversification, predominantly healthcare. So we want to see, is there any hospital upgrades happening, that it's not just reliant on one industry. We want to see real owner-occupier demand in higher socioeconomic pockets of the areas. So as far as major regional centres, we really like, Albury, Geelong, Bendigo, Ballarat. I see, first-time investors, they might have read in the forum and they're rushing out to Ararat, which is in the middle of nowhere in Victoria, has like 8,000 people. I know it for like a prison. It's like, no, that's like, I think that's like, but it's like a similar kind of like, it's okay. Except the Ararat has an I. This Ararat has like an ARA.
Okay.
But, and it's like, yes, you may see growth of 100K, but then it'll stall because there's no fundamentals there. So there's nothing to increase people's incomes. There's no industry. There isn't the propensity, like people don't have on their Pinterest board, well, not people I know, that they want to move to somewhere in the middle of nowhere, because where's the opportunities? So you want to think about who's your future buyer. So if I'm thinking about our future buyer, they're going to be priced out of Metro Melbourne. They're going to be priced out of Sydney. They're going to be priced out of Brisbane, Perth. Where's the areas surrounding there that show really great promise and affordability? I'm always looking that 5 years ahead.
I mean, the equivalent for Sydney, not to put words in your mouth, but you can see that capital growth having flowed through into Wollongong, for example.
Well, look at what's happened to Newcastle.
So,
for us in Melbourne, I'm really giving it all away now. I'm really big on like Geelong. So Bendigo and Ballarat. They are a real like ecosystem of strength for us, data-wise, but also on the ground. So remember, a lot of this data as well is like from a 2021 census. So that's what a lot of these platforms are using for weekly incomes. So what we're really looking for is gentrification in motion as well when we're looking at a future-proof location, not just hearsay. So, we're on the ground there, talking to agents, talking to property managers, talking to locals, talking to the local police station. We're really drilling down into locations, figuring out where are the really good pockets, not just relying on data. We're really getting stuck in.
We've skipped over a very important question about what your first buys looked like when you started your property investing journey.
So they weren't like any sort of sexy property. They were like blue carpets, you know, just
Blue
I miss
carpets.
the days of like the double brick solid homes in Perth on slabs. Then we moved to Bagara, which is a really beautiful spot outside of Bundaberg. And we get really great tenants there. A lot of like transient people as well, grey nomads. We bought in.
Transient people.
Yeah.
Yeah.
So like lots of grey nomads or people
Yeah.
even settling down in Bagara. It's a really lovely spot. Townsville. We thought we'd messed up. We bought in Townsville because we bought there very early. So it was about 6 months before we saw any growth. And then we own multiple properties
In Townsville.
in Townsville.
I think the underlying economics in Townsville are pretty strong. You know, when you've
it's a
got
major regional centre.
major regional centre and you've got that I guess the best way to put it, that invariant underlying demand with, say, the defence bases up there. You will always have, you know, thousands of families coming through every year that
Correct.
will be renting there.
Yep.
And I suppose worst case scenario, if you're ever trying to future-proof yourself, as you are, that worst case scenario in those towns is jump on like defence housing. You know, you get your minimum 3% growth. I think it's 3% growth every year. You know, there are in towns like that. I find them, quite
It's a
quite
huge.
good.
It's a huge major regional centre, and even within our super, we bought a property in Frankston, and people always bag me out because
Frankston's exy now.
Well, like it is
Yeah.
because I was trying to get people onto Frankston like a year ago, and I had to push so hard with some clients, and then the clients that trusted us, we were buying Frankston the 600,000s. Now they're 800,
Yeah, easy.
and even one client got revalued at 900 in the space of a year.
Yeah.
We'd bought ourselves there for 800, and in 6 months it had grown to like 950.
Yeah.
Again, these are like off markets built through relationships. I'm not saying all off markets are great, but because we're doing everything ourselves, like Melissa and I, we have those relationships. We're in the business every day. We're not separated in some ivy tower, you know, palming it off to some new hire. We're actually in the trenches with our clients, building with them.
Yeah, I've not obviously been on the ground in Frankston like you have, but you know, in my day to day, I always scroll through the CoreLogic data on all, and oh my goodness, it's flying.
And it's only starting.
Yeah, and I'm saying this. I don't have any properties in Frankston. This is literally just me looking.
Look at other parts of the LGA as well.
Yeah.
So really like Langwarren, we've bought a number of properties there. Carm Downs. So love all those areas. And again, we're not like one of these buyer's agent that really like holds the keys to their locations. Like there's nothing groundbreaking. Everybody's buying in the same
Oh, that's why they go up, right?
areas. Well, 100%. Well,
Yeah.
look at Darwin.
Yep. Yeah, I know. There's a big flood.
Never bought there.
You haven't?
Never.
No. Well, I mean, why not?
Why?
Oh,
Well-
I was just making conversation.
Well,
but yeah.
why not? Well, I just feel like there's better areas that are running at the same time that have better
100%.
fundamentals.
Yeah.
I never want to expose our clients to a risk where there's perhaps a lot of investors buying in an area. I would just leave this question kind of hanging in the air. Would Darwin have risen as quickly as it has if there wasn't as many investors buying there in the last year?
What's the data looking like at the moment?
Well, it's grown by like 20%.
Well, that's big. Yeah, okay. Yeah.
So, but who's going to buy these homes when they go to sell them?
Yes. Unless it's another investor and you got off the train first.
Correct.
Yeah.
But
Yeah.
then it's the poor investor then that is buying in there thinking, oh, it's a really good yield.
Yeah.
And they're left then holding a property.
Which is where that speculation aspect comes in, where you're jumping on a bandwagon, and there's a lot of obviously bandwagon investing going on. You see it all the time. It's when people are. Oh, look, your point's right. Where in some of these areas, it's no secret that a lot of investors are buying there, and it's going up. There also are. I think it's reasonable, say, some postcodes around the country where it's only going up because of investors, because you're herding in with several hundred people.
I
into town.
agree, but you have to remember that even the people selling these areas don't believe in them long term because they have an exit plan. So look at Geraldton. So Geraldton had really great growth, and now everybody's gone, unless it's some person buying there at the peak, or unless it's some buyer's agent who doesn't know what they're doing, putting people into Geraldton now.
Yep.
It's going to be the same story with Darwin, and I guess I just feel like it's really important to acknowledge that. And again, that's my opinion and whether it resonates with you or not. I'm just not into trading properties for the sake of it. I think, yes, there's a time to sell. A time to sell would be when your borrowing capacity is capped out and one of your properties has doubled. Sure. But don't go trading markets because it's great when it works, but there will come a point where you'll be left holding the baby, so to speak, and you can't sell your property.
Yeah, that's a fantastic way of looking at it. When you do flood into a market, when you flood into a postcode, and everyone has an exit strategy, there is a definite endpoint. Like there is an endpoint here where it doesn't keep going up.
Correct. So, and that to us isn't future-proof investing. That, as I said, Liam, we just want people to have an easy time investing. People overcomplicate it so much. They're trying to shove walls into things and turn 3 beds into 4 beds, or they're painting and carpeting, or they're thinking they're developers. Like, feasibilities don't stack up now. Just keep it simple. Buy ordinary homes for ordinary people in affordable areas that is scarcity with low building approvals, and you'll be right.
And on that note, that's a fantastic way to wrap up the podcast. Thank you so much for joining me, Dawn.
Thanks, Liam.
That was Dawn Fouhy, Future Proof Property Advisory co-founder, and we'll be back at the same time in just a short few days' time, actually, with another episode of the Smart Property Investment Show. But until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.